macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Please don't feed the bears, or at least don't make a habit of every week. Last week, I looked at the chart and I said, given the Washington situation, we should be selling the rallies. Let's not wait for Godot to come save this market as it seemed to be taking place. Let's go back and look at the chart I showed you last week. All right, this was from October 9th, Wednesday. Here's where we were sitting in the morning, and I said the market would have a hard time getting back up through this 1680 level. Well, the good news is that in our technical program in Market Timer, we were buyers anyway at 1650 on the S&P. So we actually bought a couple hours after that just for the short-term trade. I was just looking for the trade up to 1680. And we got that really quick. And then what did the market do? It proceeded to blow through this congestion. Getting through 85.95, I think, was a big deal in the past week here. And, you know, it just speaks of continued strength in this market. Now, what I want to do is show you the bear case. Some new bears have rolled out. You know, we've had some bears change into bulls, like Jeff saw it. We've got the bear from Bank of America, the chief technical strategist there, who is still bearish and still calling for this market to drop. And I'm going to introduce you to Christopher Mullen in a minute. Let's take a look now at bullish percent indexes from my friend Chris Rowe. Remember, this is one I've been showing you for months, where this is his predictor of a longer-term topping process. The black and red line is the bullish percent index on the New York Stock Exchange index, the NYSE index. And then price is laid behind that, the black line. All right, so what I've shown you before is the bullish percent index, which is the number of stocks in an index on a point and figure buy signal, makes a new high. The market hasn't peaked yet. Then the market peak makes a new high, and the bullish percent index makes a lower high. So this is what you've got going on here. This red line is lower highs in the bullish percent index on the New York Stock Exchange, and yet price continues to rise in this green channel. This is a form of divergence that signals an intermediate to longer term topping process. Same thing in the S&P. So I just did bullish percent index on the S&P 500 against the black line running behind it is the index itself. Same story. Lower highs in the bullish percent index, and the market continues to chug higher. This is a bearish divergence. All right, again, that was something I learned from Chris Rowe, and I talk about it often only because it's worked for him for 15 years to call intermediate and longer term tops. So the statistics are there, so to speak, and it works for him. That's why I continue to point it out. Now let me show you my other chartist who's turned to a bear. Oh wait, first I want to show you this is another way of looking at, you know, relative strength within an index. This is the number of stocks in the S&P 500 over their 200-day moving average. Look how this continues to it's grinding down. You know, when you're in a strong bull, you're up here above, you know, 75%, just chugging along. This indicator doesn't trend. It's just, you know, what is the state of the market? And it's fun to look at these by sector too. See how many stocks in a sector are above their 50-day, above their 100-day. So this is another way of getting a gauge of market breadth. You've got S&P 500 stocks, you know, testing this 75% level, staying above the 200-day moving average, and slipping down. All right, now this is Christopher Mullen, and he is plotting the S&P against its own relative strength. So you've got the relative strength over here on the left-hand margin. You've got, you know, 30 and 70%. You know, market gets overbought above 70%. Here was the 2011 decline. You know, that was a unique story all by itself. A lot of folks looking for that to play out again since we're having the same sort of debt ceiling fight. Where are we now? Well, relative strength, you know, has been real strong into this year, makes a peak, and now is making lower highs. And he thinks that bodes for a big correction coming. Now, this indicator by itself, I mean, even with the bullish percent indexes and this relative strength, not enough to make a bear case. And I'll I'll get to why I don't think it's enough. Let me talk a little bit more about the bear case from Vermeulen. This is what he's looking at for the longer term top here. He thinks, okay, what do markets do? You know, if we're in this expanding, broadening formation, in 2007 we make a new high and we fall off. Again, that was for different fundamental reasons having to do with the financial crisis. And so he thinks we're getting near a top now. I still don't think so, but you know, he's looking for, you know, a way to make big money in the next 18 months off of a big bear market, and I just don't see it. Here's my chart. Remember in June I called for 1800 before 1400, and actually I borrowed this chart from somebody else because, you know, I don't like hard trend lines, but these are trend lines that people are watching. You know, if we break down through 1666, you know, then it sets up this longer trend line that we have in force, which would take us down to, you know, say, you know, test 1630, 1650 again. But we were just there. You know, this market looks tough, price is strong, and these green lines are my areas of support. Let's go all the way down to the bottom first, 1100. In 2011, I called this 1150 area an extreme value area, and I said for long-term investors, you had to be a buyer down here in a S&P 1100 handle. Then as the market gained new strength throughout 2012, I said 1300 is the new 1100. And I've marked 1350 here because that's really where you'll see support on any sort of big, you know, major correction that would take us down there, approaching a bear market. But then this band here, 1500 to 1600, I see even stronger support, and that's why I still call for 1800 before 1400. So there's Vermeulen saying, you know, hey, we're gonna top out here, and it's all going to be over soon. Now he's not saying this is going to start this week, but he thinks it's coming very soon. Yeah, it's possible. I would say, you know, you've got a few other things to watch, and so what are my three big windows on the market? Technical, fundamental, and behavioral. Technically, you cannot argue with the price strength right now. Okay, so you can show me all kinds of indicators about relative strength weakness, and Vermeulen's looking at tech and financials sort of peaking and, you know, price making these ascending wedges, and that when those fail, you know, it'll take the market down. He could be right, but right now you cannot argue with price strength no matter what all these divergences and bearish oscillators are showing you. Okay, fundamentally, you've got Europe rebounding, China has bottomed, and the U.S. is still strong. And you've got, you know, what are the two main things you need just to make sure that, you know, to give the market a chance? The Fed's on our side, and we're not headed towards a recession. You put all that together, the fundamentals are still there. And even though earnings estimates have to come down, and we keep coming into a new quarter where it's you know, everybody's looking for 5 to 10% earnings growth, and that has to get pulled down to, you know, 2 to 4%. That will probably happen in the fourth quarter too, especially with spillover effects from this government shutdown. But the fact of the matter remains is that we keep making new records in corporate profits, and that keeps money managers, you know, on the buy side. All right, and that brings me to the behavioral aspect. You know, my simple rules are fund managers have to buy and they don't have to sell. So when you're in an environment like this, for them to compete and you know, meet their benchmark and try and outperform their peers, they have to be buyers of stocks here. They cannot be getting short, and you're seeing that right now. They're waiting for this to get resolved in Washington so that they can get back to the business of buying stocks. You've got the Russell at all-time highs, NASDAQ at new bull market highs, and the S&P, Dow, and NYSE will follow if those growth areas follow. So am I still in sell the rallies mode? No. I had to switch that last week after we got through that. Let's go back here. Once we got through this 85-95 area that I thought would be heavy resistance, and you know, we're above 1700, I'm back to buy the dips because it looks like we're going to get a solution out of Washington and not threaten our credit rating. So, you know, you put this all together, we can feed the bears entertain their concepts, look at their charts, but until the technicals, fundamentals, or behavior change, I think you need to be bullish and still looking for S&P 1800 in the next 2 to 3 months. All right, I'm Kevin Cook. Thanks for joining me in the kitchen, and we'll see you next week.